If you think you have a strong risk appetite, then you should take a look at Bill Hwang, a trader who manipulated markets, traded on insider information, and used several different prime brokers at different banks simultaneously to maximize his leverage when trading just a few chosen equities. Bill Hwang managed to lose a whopping $20 billion in just over 10 days inside his family office, Archegos Capital, which caused Credit Suisse to shut down their prime services division altogether. But let's go back a bit and examine in more detail how Hwang managed to lose so much money so quickly, whilst also bringing banks like Credit Suisse, Nomura and Morgan Stanley to their knees. Hwang first worked for Hyundai Securities in New York, before moving on to Peregrine Investments, which was liquidated during the Asian financial crisis. The company culture has been described as overconfident and risk-taking. BNP Paribas acquired the firm when it collapsed, which made up the Asian arm of the firm's investment bank at the time. During Hwang's time at the firm, he met Julian Robertson as a client, who was a billionaire fund manager. Hwang went on to work for Robertson's Tiger Management, which closed in 2000. Robertson reportedly gave Bill Hwang $25 million to launch Tiger Asia Management, which grew to over $5 billion in assets. Perhaps one of the first warning signs was in 2012 when Hwang and his fund admitted to illegally leveraging inside information to profit, in which they settled for a penalty of around $60 million. Subsequently, in 2014, Hwang was banned from trading in Hong Kong for 4 years. Hwang closed Tiger Asia Management to form Archegos Capital Management, a family office, with no outside investment, which allowed him to trade with lighter regulations. During the pandemic, Hwang started using a new, highly leveraged strategy to maximize exposure to the market. Hwang's Archegos used a derivative called a total return swap, in which Hwang was promised returns based on the performance of a handful of stocks, which he picked out through his total return swap. Therefore, Hwang was able to accumulate massively leveraged positions in these stocks without actually owning them, and with no need to disclose any of his stakes. Archegos had a few large derivative positions, but the largest was in ViacomCBS, in which the position was worth more than 50% of the entire market cap of the company. Although some clients may choose to be transparent with their prime brokers about using other bank services as well, this is not a requirement. However, Hwang was actually asked about his activities with other prime brokers by several of the banks, in which he misled and obscured Archegos' activities in order to achieve more leverage. Of course, this misrepresentation would be considered, well, let's just say, highly legally questionable. But anyway, as a result, Archegos Capital Management and Hwang were able to use as many as 9 banks to accumulate a simply insane amount of leverage, with reports of this being as much as 1000%. Now, of course, using so much leverage without cash to back it up is incredibly risky, and positions turning against you even a little bit can cause considerable liquidity constraints when being subjected to margin calls. On March 22, 2021, ViacomCBS, in which Hwang was exposed to more than 50% of the company, announced a secondary stock offering, which caused shares to sink. Bill Hwang responded in the only way he saw fit, in which he used his remaining $2 billion to try and push the stock back up. ViacomCBS shares unfortunately continued to sink for Bill Hwang, and Archegos had nowhere near enough money left to meet margin requirements that were being asked from prime brokers. Archegos did try its best to delay banks' requests, but it became a waiting game between the bank's risk management departments. Whoever sold and wound down Hwang's positions first would lose less, as these orders would subsequently send the market down lower and lower. However, banks that were tricked by Hwang may have been left holding even larger losses after more risk-averse or sensible banks, depending on how you look at it, got out earlier, which pushed ViacomCBS lower. Credit Suisse, which has long been plagued by scandals, seems to have been one of the banks which suffered the heaviest losses, causing them to shut down their prime brokerage division entirely in 2021, after losing a whopping $5.5 billion due to Hwang's antics. Other banks also lost a lot, with Nomura losing $2.9 billion, Morgan Stanley losing $900 million, and UBS losing $770 million, among others. This large loss for Credit Suisse seems almost characteristic of their risk-taking nature compared to UBS and others. in which after the collapse of Silicon Valley Bank a few weeks ago, we saw Credit Suisse being acquired by UBS, after concern that the systemically important financial institution could fail, potentially causing another global financial crisis. Hwang has since faced 11 criminal counts including racketeering, conspiracy, market manipulation and securities fraud. However, Bill Hwang could be considered a legend in terms of sheer balls and risk-taking capacity, a true madman. However, maybe he's not a legend, considering he probably stole money from countless others through unfair trading and also put the world economy at risk through placing large systemically important banks under huge strain when his scheme failed. An interesting or funny note, depending on how you look at it, is recently a nice April Fool's joke was played on Twitter in which someone said that Bill Hwang actually profited $1 billion from shorting regional bank stocks and Credit Suisse, which would be very funny considering he is a major factor behind Credit Suisse's demise. But anyway, what do you think? Thanks for watching.